Let me guess. You opened your banking app this week, saw a couple $1,000s sitting there, and thought, okay, now what? You've heard people say the stock market is how you build wealth. You've also heard people say it's basically gambling. You've seen screenshots of someone turning $5,000 into $200,000 in a year. And you've also seen horror stories of people losing everything overnight. So now you're stuck. You don't want to be broke forever, but you also don't want to be stupid. And you're wondering, how do normal people actually make millions from stocks without getting lucky? If that sounds like you, that's exactly who this video is for. My name is Noble, and I spend way too much time thinking about investing, compounding, and why most people who try to build wealth end up sabotaging themselves. If you're someone who wants to start investing but feels overwhelmed, confused, or scared of losing your money, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Look, here's the thing. When people hear, "I made millions from stocks," they imagine some genius trader staring at 6 monitors, timing the market perfectly, making lightning-fast moves. That's not what I do, and honestly, that's not what most real millionaires in the stock market do either. Let me challenge an assumption right away. The average annual return of the S&P 500 over the last roughly 90 years has been about 10% per year, according to data compiled by Standard & Poor's and long-term historical market research. 10%. That's it. Not 100%, not 50%, 10. And yet, over time, that 10% has created millions of millionaires. Here's what most people don't realize. It's not the return that makes you rich, it's the duration. Let's do the math, because the math is where this gets powerful. If you invest $500 per month starting at age 25 and you earn an average of 10% annually, by age 65, you're sitting on roughly $2.6 million. You only personally contributed $240,000 over those 40 years. The remaining $2.36 million? That's growth. That's compounding doing the heavy lifting. Now you might be thinking, okay, Noble, that's 40 years. I don't want to wait 40 years. I get it, nobody wakes up excited to wait 4 decades, but here's where it gets really interesting. The majority of that $2.6 million doesn't show up in the first 20 years. It explodes in the last 10 to 15. Compounding is like planting a tree. The first few years it looks unimpressive, a stick in the ground. You almost feel dumb watering it. But underground, the roots are spreading. Then one day, it's towering over everything. Most people quit watering the tree before it grows. And this is where psychology enters the conversation. Dalbar, a financial research firm, consistently reports that the average investor underperforms the market by several percentage points per year. Why? Not because they're stupid, not because they picked the wrong stocks, because they panic. They buy when things feel safe and exciting. They sell when things feel scary. Emotion destroys returns. I'll tell you a quick story. When I first started investing, I thought I needed to outsmart the market. I'd read articles, watch earnings reports, try to predict short-term price movements. And every time the market dropped 5% or 10%, I felt this pit in my stomach. I think maybe I should sell before it gets worse. Sometimes I did, and almost every time the market recovered without me. Here's what most people don't realize. Volatility is the price of admission. If you want the long-term 10%, you have to tolerate short-term chaos. In 2008, the S&P 500 dropped about 57% from peak to bottom. In March 2020, it fell roughly 34% in a matter of weeks. Both times, people said, this is different. Both times, the market eventually recovered and went on to hit new highs. Now, I'm not saying markets only go up. They don't. There are lost decades. There are painful stretches. But over long enough time horizons, productive businesses tend to grow. And when you own broad slices of those businesses, you grow with them. So how do I personally structure this? First, the foundation of my portfolio is broad index funds, low-cost funds that track the overall market. Because here's another shocking stat. According to SPIVA reports, over a 15-year period, roughly 85 to 90% of actively managed large-cap funds underperform their benchmark index. That means even professionals with teams, data, and resources often fail to beat simple index funds. So I don't try to be a hero with most of my money. I accept the market return. Second, I add selectively chosen individual companies that I understand and believe have durable advantages, businesses with strong cash flow, competitive moats, and long-term growth potential. But this is a smaller portion. The core stays diversified. Now, you might be thinking, but Nick, I don't make enough to invest $500 per month. That's fair. Let's shrink the numbers. What if you invest $200 per month starting at age 22? At a 10% average return by age 62, that's about $1 million. $200 per month, that's $6.67 per day, less than many people spend on coffee. This isn't about deprivation, it's about direction. Small, consistent inputs over long periods create disproportionate outputs. But let's go deeper, because this isn't just math, it's identity. When you decide to invest consistently, you're saying, I am the kind of person who delays gratification. That psychological shift changes other behaviors. You become more intentional with spending, more focused on income growth, more resilient during downturns. Income growth is the multiplier most beginners ignore. If you start at $200 per month but increase your investments by just 5% each year as your salary grows, the final number balloons. Instead of $1 million, you might be looking at $1.5 million or more. Here's the analogy I like to use. Investing is like pushing a flywheel. At first, it's heavy. You push and barely see movement. That's the first $10,000, the first $50,000. It feels slow. But once momentum builds, each additional push produces more rotation. When your portfolio hits $500,000, a 10% year adds $50,000 without you doing anything. That's more than many people save in an entire year. This is where it gets really interesting. Eventually, your money starts working harder than you do. But let's address the big fear. What if I lose everything? Look, if you're putting all your money into a single speculative stock, yes, that's possible. But if you're diversified across hundreds of profitable companies, the risk isn't zero, but it's dramatically lower. For the entire market to go to zero permanently would imply a complete economic collapse. Risk in investing isn't just losing money, it's also losing purchasing power by sitting in cash. Inflation historically averages around 2 to 3% per year in the U.S., though it spikes higher at times. If your money earns 0% in a savings account while inflation runs at 3%, you're effectively losing 3% in real terms annually. So the question isn't, is investing risky? The question is, compared to what? Here are the actionable steps I would give a beginner. First, build a 3 to 6 month emergency fund. This prevents you from being forced to sell investments during a crisis. Second, eliminate high-interest debt. If you're paying 20% on a credit card, that's a guaranteed negative return bigger than the market's average positive one. Third, open a brokerage account with a reputable platform. Choose a low-cost index fund tracking a broad market index. Fourth, automate monthly contributions. Automation removes emotion. You invest whether the market is up, down, or sideways. Fifth, increase contributions whenever your income rises. Treat raises like fuel for your future, not excuses for lifestyle inflation. Now, let me be slightly frustrated for a second. The reason most people don't build wealth is lack of intelligence. It's inconsistency. They start, the market dips, they stop. They restart during a bull run. They chase performance. They abandon strategy. Wealth building is boring, it's repetitive, it's disciplined, and because it's not flashy, people underestimate it. But here's the beautiful part. You don't need to be extraordinary, you need to be slightly average for a very long time. If you earn average market returns and avoid catastrophic mistakes, you're already ahead of most participants. Remember, many investors underperform because they jump in and out. So when I say I make millions from stocks, what I really mean is I let time, discipline, and compounding do the heavy lifting. I focus on increasing my income so I can invest more. I stay invested during downturns. I ignore noise. I think in decades. And I constantly remind myself that every dollar invested today is a tiny employee that works for me forever. Imagine you hire one employee today. They produce $0.10 next year. That seems trivial. But if that employee produces 10% more every year and you keep hiring more employees, eventually you're running a massive operation. That's your portfolio. Here's what most people don't realize. You don't need a viral stock pick. You need a repeatable system. The system is simple. Earn, save, invest, repeat. Increase inputs over time. Stay patient. Avoid emotional decisions. If you're 20, 25, even 35, you have time on your side. If you're 45 or 50, you still have leverage through income growth and disciplined allocation. The biggest mistake would be doing nothing because you're afraid of imperfection. You don't need to time the bottom. You don't need to predict recessions. You don't need to watch financial news every day.
you need to start. Start small, start imperfectly, start with an index fund and a fixed monthly amount. 10 years from now, you won't regret investing consistently. You'll regret the years you waited. So, if this shifted your perspective even a little, if you now see that millions from stocks isn't about genius but about discipline, make sure you subscribe because we're not here for hype, we're here for long-term wealth. And remember, the difference between someone who builds financial freedom and someone who stays stuck is rarely intelligence. It's usually the decision to begin and the commitment to continue. I'll see you in the next one.